The pen is heavier than it should be, not physically. Physically it's a standard Bic, the kind that lives in a cup on a desk and belongs to no one. But the paper underneath it has a number on it. $62,400. And when you sign your name below that number at 18 years old, sitting in a financial aid office that smells like carpet cleaner and institutional hope, you don't feel the weight of it. You feel the opposite. You feel chosen. Your mother is in the waiting area. She drove 2 hours to be here. She is wearing the good jacket, the one she saves. And when you walk out with your enrollment confirmation, she hugs you in a way that compresses something in your chest you don't have a word for yet. First in the family. Nobody says it out loud. Nobody has to. The loans feel abstract in the way that all future obligations feel abstract at 18. 47,000 federal, 15,000 private. Deferred until 6 months after graduation. A problem that belongs to a future version of you who will, presumably, have things figured out. You don't do the math. Nobody suggests you should. For years past the way expensive things do. Fast, and with receipts. You study something that interests you. Maybe it's psychology. Maybe communications. Maybe a business degree from a school whose name carries just enough weight in your zip code to feel like it means something. You do the work. You earn the grades. You walk across a stage in May sunlight, while someone mispronounces your last name into a microphone. Your mother is in the third row. She is wearing the good jacket again. 6 months later, the first bill arrives. $579 a month, federal loans. And then, 11 days after that, a separate letter. Private loan servicer. $241 a month. Different company. Different due date. Different interest rate that you didn't fully understand when you signed for it at 18 and understand even less now. $820 a month, total. Before rent. Before groceries. Before the car payment on the used Civic you needed to get to the job that pays $38,000 a year, which is a real salary, your first real salary, and which, after taxes and the loans and the rent and the insurance, leaves you with approximately $190 of discretionary income per month. You tell yourself this is temporary. Everyone tells you this is temporary. You are 26. The job has become a career, loosely defined. You got a raise. A real one. $48,000 now, which felt enormous until the loan payments absorbed the difference so cleanly it was as though the raise never happened at all. This is called lifestyle debt maintenance. Nobody calls it that out loud. It just feels like running slightly less behind. Your friend Priya graduated the same year you did. She did 2 years at community college, transferred, finished with $11,000 in debt total, and spent the last 4 years paying it off, while you spent the last 4 years paying mostly interest. You look up your loan balance one Thursday evening and feel something cold move through you. You have made 48 payments of $820. That is $39,360 you have paid toward this debt. Your remaining balance is $51,200. You started at $62,400. You have paid $39,360. You still owe $51,200. The math doesn't add up until it does. Until you realize that in 4 years of payments, you have reduced the principal by approximately $11,000. The rest went to interest. The private loan alone carried a 9.8% APR, which was disclosed on page 4 of a document handed to you at 18 in a room that smelled like carpet cleaner and institutional hope. You sit with that number for a long time. The career was supposed to outrun the debt. That was the implicit promise embedded in every conversation about college, every brochure, every well-meaning adult who said invest in yourself. The degree was the asset. The loan was the price of the asset. The salary was supposed to make the math work. What nobody modeled out for you was the compounding cost of the gap years. The years between signing and earning, where the interest ran quietly in the background like a meter nobody showed you how to read. You are 29. You have a spreadsheet now. This is either growth or damage, depending on how you look at it. The spreadsheet says this. Total amount borrowed, $62,400. Total amount paid to date, $58,000. Current remaining balance, $44,800. Projected payoff date at current payment rate, age 38. Age 38. You will be paying for a degree you finished at 22 until you are 38 years old. But that's not the number that breaks something in you. This is. Your coworker James, same age, same company, similar role, has been putting $800 a month into a Roth IRA and index funds since he was 24. James graduated from a state school with $6,000 in debt, paid it off in 14 months, and redirected that payment into investments the following year. James is 29. His brokerage account has $87,000 in it. You have $1,400 in savings and $44,800 in debt. The net difference between your financial positions is not the difference in your salaries. It is not the difference in your disciplines. It is the difference in your starting lines. James began building at 24. You are still paying for the right to have started. That $62,400 degree, financed at the rates you were given, at the age you were given them, will cost you approximately $94,000 by the time it's retired. The Bureau of Labor Statistics data on wage premiums for bachelor's degree holders is real. The premium exists. What the premium projections rarely model is the compounding opportunity cost of a decade of redirected capital. The money that went to interest didn't just disappear. It didn't go to the future version of you. It went to the servicer, every month, automatically, without drama. That is the real number. Not $62,400. Not even $94,000. It's the $87,000 that never existed in your account because the $820 a month had somewhere else to be for the last 5 years. You are 32. The debt is still there. Smaller now. More manageable. You refinanced the private loan 2 years ago, when your credit score finally cooperated. Dropped the rate from 9.8% to 6.1%, and saved yourself something real. You are making progress. The spreadsheet confirms it. But progress and peace are different things. There is a specific kind of exhaustion that comes from a decade of financial obligation you took on before you were old enough to model the consequences. It doesn't announce itself. It settles in the way all chronic things settle in, as background noise, as a slight tightening around certain conversations, as the version of you who doesn't fully say yes to things because some part of your brain is always doing a quiet calculation in the background. Your mother asks about a house. Here is what nobody tells you when you sign the paper at 18. The degree is real. The knowledge is real. The credential opens doors that stay closed without it, and that is not nothing. That is worth something. But the financing structure wrapped around that credential was designed by adults with full information for a teenager with none. The interest rates on private loans are not educational policy. They are lending products. The deferred repayment structure that makes $62,400 feel abstract at 18 is not an accident of design. It is the design. You were not failed by ambition. You were not failed by effort. You were handed a 20-year financial instrument at the age you were first allowed to vote, and told it was an investment in yourself. It was. It was also a product. Both things are true simultaneously, and the system benefits from you only ever seeing one of them. At 32, with the spreadsheet open and the payoff date circled and the brokerage account finally, slowly beginning to exist, you understand something you couldn't have understood at 18. The question was never whether college was worth it. The question was whether $94,000 financed at those rates at that age with that career runway was the only path to the life you were trying to build. It wasn't. You know that now. You can unknow it. What you can do is make sure the next person who sits down in that chair, in that office, with that pen in their hand, and that specific unrepeatable feeling of being chosen, gets asked one question before they sign. Have you done the math? Not the 4-year math, not the salary premium math. The full math. The 20-year math. The what this costs when the interest runs math. That question costs nothing. The answer changes everything. Subscribe Leo Finance so you don't miss the next one. See you in the next.